Thank you, Fastmarkets, for having Rodney and me back to speak at the lithium industry's flagship conference. It's great to be here and see so many old friends in person, and also to reach the large virtual audience listening in. As always, I'm going to speak about developments in lithium equity financing and M&A, and interpret what messages are contained from Mr. Market and the moves by various strategic players in the market. RK Equity has been in business for nearly 20 years, with a particular focus the last 12 years as investors in and advisors to lithium and other battery materials companies. This is a list of all the battery materials companies we have worked with. And this disclaimer references which companies we currently have equity interests in. Please note, RK Equity is not a financial advisor, and nothing we say here should be construed as investment or financial advice, so please do your own research. Back to school. I spent much of the summer on college visits with my eldest son, Jamie, now a senior in high school. Those familiar with Rodney Dangerfield will appreciate the double entendre here. Lithium is getting respect. Here's my back-to-school picture in 1986, my high school graduation. During Lithium 2.0's bust, I drew from Steve Winwood's early career, narrating traffic and can't find my way home, and I counseled to have blind faith. Lithium 3.0 is like 1986, Winwood's middle-aged peak MTV years, where he achieved his greatest popular success. Back in the high life again, higher love. That's where I and all lithium investors find ourselves today. As lithium prices began in June what became a parabolic ascent, lithium equities were lagging or trading sideways. I suggested in mid-June in the tweet over here that Mr. Market was presenting a gift, that higher love was on its way. Many stocks on RK Equity's lithium equity scoreboard, on the ASX in particular, have since hit 52-week or all-time highs. But many other names which rose earlier this year to undemanding valuations of $250 million or below are still down 20 to 40% from those levels. Many of these offer relative value, in my opinion, and are poised to re-rate as mostly vaccinated North America goes back to school and work and digests the growing tailwinds behind the lithium investment thematic. Build Back Better Biden's buyer subsidies are making their way through the legislative sausage machine. Watch this video from 2 weeks ago with Ken Brinsden of Pilbara if you haven't already. The key takeaways, spodumene speculation, is pricing is very strong and going to get stronger. If capital does not start to flow upstream, pricing is only going to get more extreme and assets are only going to get more expensive. So imitating life, spodumene and iron ore, Pilbara and Fortescue, for those familiar with that company. Less than a year ago, Altura was tottering under the weight of vulture lenders, Chinese off-takers reneging on their price floors, and SQM's predatory pricing. Ganfeng's filings narrated a survival of the fittest Darwinian struggle. I empathize greatly with my former client and friends at Altura. Ken Brinsden, Pilbara, and their advisors at Macquarie played a brilliant M&A game, securing a terrific and highly synergistic asset for just 220 million Australian dollars, essentially replacement value. Resource capital funds and Oz Super, who backstopped the $100 million equity at 36 cents to finance that purchase, are up 6 times in less than 1 year. A fantastic result. Pilbara has grown from 0 to 5 billion market cap in just 5 years. Fortescue's been around for 15 years and had a similar near-death experience in its early years. Before their recent sell-off last week, FMG had a market cap of 55 billion Australian dollars. So I consider Pilbara the new force in spodumene, if you're familiar with the new force in iron ore, Fortescue. Pilbara is now the swing supplier of spodumene. Can they grow 5 to 7 times to FMG's market value in the next 5 to 10 years? We shall see. The iron ore chart on this shows 2 upward arrows punctuated by the global financial crisis from the 2006 to 2011 period. There was the Obama and the China stimulus in between. This looks to me like the Lithium 2.0 bust exacerbated by COVID and the subsequent Trump-Biden stimulus still ongoing as Lithium 3.0 marches on. My friend Robert Friedland suggests we are in the revenge of the miners mode. Pilbara's Altura purchase and its mothball and Albemarle Luke Kassam's genius buy of Wodgina is resulting in Pilbara's day in the sun. The BMX platform is a brilliant innovation, providing much-needed transparency and price discovery and negotiating leverage. This graph shows the addressable margin Pilbara is capturing now that the lithium market is in a period of excess demand and tight supply, caused in no small part by Pilbara's discipline. Pilbara will now restart the ex-Altura mine and sell all of the 200,000 plus unallocated production at spot prices. Payback on the Altura purchase could be less than 1 year. Pilbara published its forward spodumene shipment and cost guidance last month. Ignoring its mid and downstream aspirations and assuming they meet the midpoint of their guidance, Mr. Market is currently fixing very high expectations for spodumene concentrate pricing over the next few years, or they're valuing spodumene concentrate producer like Pilbara at a specialty chemicals like multiple rather than traditional commodities like iron ore. If you believe spodumene concentrate prices will be $750 by 2025, Pilbara is trading at a 15 times 2025 EV to EBITDA. If prices are at $12.50, in which case Pilbara will generate 67% EBITDA margins, it's trading at 7 times 2025 EBITDA. These are margins that Rio Tinto was receiving in the last few years up until the recent iron ore bust, and for which the market typically is affixing 7 times multiple to Rio Tinto, but that's based on this year's earnings, not 2025. If you believe 2,500 spodumene concentrate prices are the future, then Pilbara looks dirt cheap. But it seems unlikely that such a price is sustainable. Can the EV market demand really hold up at what equates to $30,000 a ton chemical prices? It takes two to contango. The carbonate and hydroxide prices are now forward at $23,000, up from $19,000 today, according to SCB. The LME and the CME hydroxide contracts have been very slow going. The CME presented here yesterday and basically said they've made just 2 trades of 5 tons each, one I think in June and one in earlier this month. Meantime, a more liquid China carbonate exchange, the WUXI, which launched in July with a 3-month forward price of $13.50, has now nearly doubled in 3 months to $26,000. This WUXI for carbonate and Pilbara's auctions for spodumene concentrate are the leading price indicators to watch, reflecting the most liquid, uncontracted spot China market. Reg Spencer, head analyst at Cathode, which has been the most prolific lithium equity capital raiser over the last 10 years, suggests the lithium industry needs $3.5 billion every year for the next 10 years. On a recent podcast with us, he basically said, if I was Volkswagen or Ford or GM, I'd be panicking. OEMs are in most need of increases in supply. We really need to see these guys writing checks. Exactly 1 year ago tomorrow, Battery Day. Tesla, always years ahead of the competition, wrote a check to build the first lithium hydroxide plant in Texas. And at the cycle bottom, it signed a binding 5-year offtake fixed price for localized spodumene in North Carolina. Tesla's chairwoman, Robin Denholm, talks about low carbon footprint, localizing supply chains. In June, she said the best way to reduce the carbon footprint of minerals is to stop shipping them across 9,000 kilometers of ocean before refining them. In addition to our video podcasts, RK Equity has started a series of short Q&A with Rodney Hooper videos covering specific topics like all-electric future, lithium green premiums, and the North America's scramble for lithium. Rodney wrote on LinkedIn in January that 2021 is lithium's year, saying OEMs squeezing suppliers is a short-term move that has long-term consequences. EV producers and developers sporting super high valuations can't win unless lithium developers and producers also win. In an expert call with David Deckelbaum at Cowen, who you're going to hear from shortly in May, Rodney predicted greater than $15,000 prices by now, and $18 to $20 prices by the end of the year. Turns out he was too conservative. What's Rodney have to say now?
I'm going to be discussing the lithium trends, and in particular, what real lithium demand is and fair value pricing. If we look at what we've seen of late, the main thematic is cathode is king. If we look at recent chemical price movement, it suggests cathode production demand, less inventory at the end of last year is the most relevant pricing indicator. For 2021, we're now looking and forecasting at over 1.2 million tons, which is a 70% year-on-year or more. And looking at it on a gigawatt hour equivalent basis, about 640 versus batteries sold 460 and batteries installed 390. And why is that? COVID impact on logistics, higher demand, and then cell scrappage and replacements have meant increased inventories across the supply chain. Two dominant technologies that are emerging in the cathode market in China is LFP and high nickel, and China's share of the cathode market has grown. Korea as well, and Europe and Japan seem to be off slightly. If we look at 2021 lithium demand just on batteries sold, you get a 430 to 450 number, which is what you see a lot of the banks publishing. But if you look at cathode production, and in our view, yes, there can be inventory build, but if it goes in cathode, it's got to come from somewhere, and that number is more like 500 to 520,000 tons. And why is this? And Howard mentioned I was too conservative. I had a 5.3 million EV cells target for the year. Consensus is now probably 500,000 higher than that at 5.8. And China is likely to reclaim #1 spot in 2021 and retain that mantle in 2022. What's happening? Well, we have three major markets, China, Europe, and the US, all synchronized now in terms of EV sales. But from a CO2 emission standards perspective, Europe now has no stick. It's a flat line until 2025. And based on our estimates, roughly of 18.5% is what's needed as EV penetration across the EU to meet emission standards. The OEMs won't face penalties if they maintain that market share beyond 2021 until 2025. So it looks like China is going to step up again, but overall, demand is 500,000 higher than our expectation, and that's why we're seeing prices go up. If you look at LFP, Ernie mentioned it earlier, exceptional growth in LFP cathode production this year as China EV sales have risen strongly, and Tesla short-range models, the Model 3 and the Model Y, using it. But we think you should note that exports, certainly of the Model 3, exceed local sales, and that's something to watch. For the year in total, we estimate in 2021 about 375,000 tons of LFP cathode in China. That's a growth of about 168% and about 31% of total market share. There's something to keep an eye on is Chinese 3-year EV residual values are way, way below their ICE competitors. If you look at the average Chinese EV new sales price in H1 2020, it was just under 30,000. That's well above the average new car price in China. The highest growth segment is the A00, that's the mini EVs and other low cost, which is logical as EV penetration rates rise. But we think, investors should note, with no buyer incentives in the future, low residual values, and already high penetration rates in license plate lottery cities, yes, there's NEV quotas that you have to meet, but what will drive future EV sales in Tier 2 and Tier 3 once the easier sales are done? And you can look here on the table, the 3-year residual in July was 38.3% for a pure EV, a plug-in hybrid higher, and then August numbers for multi-purpose and SUV and sedan for internal combustion engine nearly 40% higher. So that's something to watch. Is it a question of quality? What's the issue at hand? Will that improve as Tesla sales improve there and new models come through? High nickel. This year we have an estimate of China high nickel cathode production in 21 of 150,000 tons. That's a year-on-year growth rate of over 200% and the highest of all cathode segments, including LFP. The high nickel market share in July got up to 42%. That was only at 22% for the whole of 2020. And we see a likely end-of-year number at 50% share by December, and 60% for the total for 2022. So high nickel is definitely picking up, and you've seen that with capacity builds from Ronbay and others in the 811 segment. So what is driving the cathode demand? Well, there's surplus battery production. If you look at China battery production, it's going into overdrive year on year, looking like 130% or higher. The estimated surplus above installed batteries for 2021, if you look at it now, we're already at 2 to 3.5 times 2019 and 2020 numbers. A large portion of that is LFP. Obviously, you've got to net off some exports, but LFP is substantial in months of inventory, NCM less, and that suggests that there's pent-up demand coming from Tesla and from others. And provided, if you look at the delay in delivery time on new models, it would suggest that this trend is likely to continue, but that is driving cathode demand. So what is the real demand number? Well, if we look at battery-grade cathode and electrolyte, we think that demand is just under 414,000 tons of LCE this year. We assumed battery-grade inventory of about 45,000 tons at the end of last year, and based on cathode and electrolyte demand this year, we should end the year at a 3.3 thousand ton deficit. And one of the things to look out for, it's very difficult to work out when to offset battery-grade demand and supply. We think demand is pulled back by 6 months with EVs, and supply is pulled forward by 6 months. Best case scenario for incumbents being qualified to 24 months, for new greenfields for that differential. So your best case scenario is a 12-month differential. Your worst case scenario is that a new producer never qualifies. We think we're in supply deficit. We're going to end the year tighter, and it will widen from 2022 onwards, provided demand holds steady given the amount of inventory buildup across the supply chain. If we look at China spot battery-grade carbonate, hydroxide, and spodumene prices, if you look at the rate at which these prices are moving, and I've got Fastmarkets' last pricing from 17 December, you're seeing moves for carbonate and hydroxide of over 10% at times in a week, and consistently, rising on a week-by-week basis. And we don't think that's the price action of specialty chemicals that have 3 months plus of inventory. We think that inventory is gone, as opposed to other views. And if you look at Pilbara's BMX auction of 2240, that tells you, given it's 5.5%, and that's zero converter margin at the current spot prices, that it's a clear sign of tightness in that market. So what is fair value? Well, based on that auction and adjusting that to a $2,500 a ton for spodumene concentrate 6%, we think on a look-through basis, including VAT, that's a 32,000, give or take, spot price. And if we look at long-term fair value, we had Ken on our podcast. He said $650 a ton for the big four, Greenbushes, Wodgina, and so on, and higher for newcomers. If we assume that a fair price for spodumene is $700 to $800 a ton going forward, then that would imply a long-term battery-grade chemical price of somewhere between $12,700 and $13,800 if non-integrated Chinese converters earn a 15% EBITDA margin on an ex-VAT basis. So if you have non-integrated converters as the marginal supply, and those are the numbers, then it bodes well for traditional brine producers, given they operate at about $4,000 a ton. They should make very decent OPEX margins, as well as integrated producers on the spodumene side. So what are the conclusions to take away? EV sales are outperforming, China back to number one. The battery supply chain is building inventory in the anticipation of continued strength in those markets. Chinese lithium producers, when markets were plummeting, they were selling everything they could on a week-by-week basis. Now they're holding back for higher prices. Now we've got US buyer incentives coming through. It'll mean all three major auto markets are competing for material. For now, it's all EVs. I cannot see on a holistic basis, if you're looking to drop GHG emissions by more than 50%, how aviation won't become a serious competitor post-2025 if we see new battery technology and high energy density with solid state and silicon doping, etc. That market, we think, will grow substantially. One thing we continue to be perplexed by is you keep seeing new gigafactory announcements, but you've got no guaranteed lithium supplies. CATL has just stepped up to bid for Millennial Lithium. Is that too little, too late? How can you keep projecting new gigafactories when you just don't have the raw materials? There is new carbonate and hydroxide coming online in 22. Qualification timelines are going to be key. What new projects can deliver soonest? We think there's buoyant financing and M&A for advanced assets that'll keep going. And will we see 30,000 for battery grade material by year end? If you look at the Pilbara auction, it suggests that's exactly the case. Thanks very much.